So when talking about numbers of the innovation ecosystem, startups, investments, and so forth, I don't think there is anybody in a better position than Crunchbase to be on the other side. So we're very excited to have with us today Gené Teare, the head of content of Crunchbase. Good morning, Gené.
Good morning. It's great to be here. Thanks for inviting me.
It's a pleasure. And here we're really at the core of a complicated number of months, and so we want to really have the ability to touch upon macro trends that from your observatory you've been studying. So maybe a little bit of a background. Gené, old friend of ours, you participated in other activities we've done in the past. It's also very interesting to see your world of reference, how Crunchbase has evolved over time. So maybe a couple of words about Crunchbase. Even before that, maybe also of you as a path. You are originally from South Africa, correct?
But yes, then, that's correct.
But then you landed here. Go ahead.
Yes. So originally I'm South African. I grew up during apartheid, and I was involved in anti-apartheid politics when I was a student in the 80s, and left South Africa just before Mandela was released to go to the UK to work. So I think for me, the Black Lives Matter movement has been it almost takes me back in time to a lot of the experiences that I had growing up in South Africa, which was far more extreme. But anyway, so that's been interesting here in the US. I think from Crunchbase's side, what we've been doing is, we've found a huge opportunity for sales and for corporate development, and obviously for investors as well, who are very interested in tracking and selling and engaging with the whole global startup ecosystem. So I think the newest developments there around Crunchbase is that we're integrated in Salesforce, but we're building tooling to make it very easy to keep up to date with your accounts, so that you can query on Crunchbase, you can update into Salesforce, and manage your accounts that way. So we're doing a lot around the sales side. I think the other thing that we're doing a lot in at Crunchbase is really doubling down on the data. And that's something I'm very close to. I joined Crunchbase back when it was part of TechCrunch. Now it's spun out. It's a Series C funded company. But I've always been focused on the data side and researching and writing from the data. We recently added diversity tags to the Crunchbase data set to companies, specifically in the US, so you can identify underrepresented founders. We've added leadership hires as a signal for you might want to re-engage with the account. And what I'm very excited about is we have new data points coming into the data set, which I can't talk about, which is going to provide a lot more utility and signal to the startup ecosystem. So I think data and tooling is sort of where Crunchbase is focused today, to make it easier to use our tools.
And we know that the plan of expansion of Crunchbase is significant. Maybe a couple of words about where you think you're headed, right? So from the early days within TechCrunch, obviously was a tool that was developed, through the research of the use of all the interviews through TechCrunch. But where is Crunchbase headed? What is the big vision?
Yeah, I think the challenge with Crunchbase, today we have 55 million professionals annually who use Crunchbase, and there are so many different use cases. There are people using it for job seeking, which I think is a very strong use case. We have investors using it just in order to keep up with their own portfolio companies and who else is investing. So it's used and corporate development use it to investigate companies. So I think it's used very extensively by many different use cases. And for us, I guess where we're going is we're wanting to focus on people accessing this universe and making those tools much stronger. So I think where we're focused is, as I've said, is a lot on the tools and making you more efficient in your work. And I think we focused on sales because it's so big, but I think there are so many other use cases who then benefit from that work.
And you're head of research there, and obviously, we're using a lot of your data, and we actually been collaborating for a number of years in part of a data sources and research. Maybe how do you move from data to trends? What's your methodology, especially, your daily job? We're going to talk about some of the latest research that you've done in the last few weeks as an examples. We talk about mega venture funds and so on and so forth. But I'm interested in learning, from the data that you gather, what's the process in drawing macro trends?
I think what's very, very interesting about the Crunchbase data set is very connected, because we have the companies, we have the funding rounds, we have the investors, and it's the mix of all of those in trying to understand, what is happening in the startup ecosystem. So I spend a lot of my time on Snowflake. I use Crunchbase Pro as a query tool because it's immediate and it's pretty strong, actually, from a research perspective. I have all these queries set up, so if any researchers want to reach out to me, they should. And then what I do, you look at the data, you look at your trends, you go back and you look at the actual data to see what's behind it. And then I do a lot of research and research off of other people who are writing to understand how what the conversation is marries with our trends. So it's a lot of back and forth between the data and then looking at what the industry is talking about.
And I think the examples that we're going to talk about in the next 20 minutes probably will show, I guess this is a gathering from, a mix between data that you gather at the core and a bunch of double check with the industry and some of the industry leaders, right?
Yes.
All right, let's dive right into it. So the overall topic that I would like to address is really some of the macro trends that you've been studying in the last few months, in particular through the pandemic. And so I think one of the initial data points that you have is really a comparative analysis of the latest crisis, the 2008 versus the 2020. So maybe give us some ideas of how those two crises are radically different.
Sure. So Mike, I went through the 2000 dot-com bust. I was in Silicon Valley, the 2008 crisis, and now the pandemic. And what's interesting to me is every time we have a crisis, it's almost like everyone looks back to the last crisis to inform what this one was about, what this one is about. And so in 2008, what was interesting is it almost felt like everything, Sequoia wrote this article, Rest in Peace, Good Times. It sent a sort of shock through the industry. But really what they were saying is everything has changed and all of your assumptions should go away. So the idea that you can raise funding in this climate, that's evaporated. The idea that you're going to be able to sell to customers, that's evaporated. Advertising is down, mobile is down, e-commerce is going to be down. And so their sentiment in the last crisis was everything is impacted. You need to buckle down. You need to do cuts are a must was one of their phrases. And you need to advance for a new reality. What ended up happening is there was a slowdown. We did some analysis which looked at funding at the earlier stages. And we saw a cut in 2009 and 2010 and came back in 2011. So funding did slow down. The market picked up more quickly than the 2000 crisis. And so even though it took a while to get back to normal, it wasn't as drastic as you would have thought in 2008. The other thing that came out of 2008, which I think has influenced everyone today, is that some iconic companies like Slack, Uber, Cabbage, WhatsApp were all created during the end of 2008 and early 2009. So immediately during that crisis, these iconic companies were created. And I think what the investors have taken from that today, and again, the pandemic is very different, but what they're looking at is great companies come out of a crisis. And sometimes when there's a culling, it means there's a clearing of the decks. The companies that emerge are in fact stronger. And so I think in this crisis, even though there has been a similar discussion around the whole world has changed, there is going to be a recession, there are going to be huge job cuts, you need to cut and get ready for lean times. What's actually happened from those very early pronouncements in March and early April is that things have turned out to be very different.
Very good. And sometimes the predictions are totally off, even of the major VC. So let's go back to data. I think one of an interesting data point that you shared, I think is probably a questionnaire from NFX, the investors, but I think is a good starting point here to see the reality. This is a subset, I assume, probably is a subset of their portfolio, but I think it's pretty representative of what the real impact has been in macro areas of different startups. So here, I think we can show real quick, and maybe we can talk over it, the different data about hiring, revenues, and the industrial areas that have been impacted the most.
Yeah, I think what's very interesting about the slide, and we partnered with NFX and provided funding data, but if you go back to the original slide, is so what NFX did is they surveyed much broader than their portfolio, the whole startup community. It was very heavily US based. And this was the second survey they did. So this was in June. The first survey they did was in April, sort of immediately after the crisis. And I think what's interesting when you look at the previous slide is only a third of companies said that their revenue was decreased, which is much less than one would have expected. And again, this is 2.5 months in. So this is when companies have had some time to assess how are they doing, how is it impacting them. And so the fact that only a third of companies saw a revenue decrease, and that kind of sentiment I felt here around the Valley, where it didn't feel like revenues were being cut away completely. They were adjusting, they were coming down somewhat, but not massively. The fact that 2/3 of companies saw no change or revenue increase is a testament to how startups have not been as deeply affected as one might have thought. If you go to the next slide, what's interesting is obviously the first things that startups are told to do is to cut staffing. And what we found is for a lot of startups, they immediately thought, we don't know what the future is. We don't know what our revenue is going to be like. So what we can do is cut hiring, so just freezing hiring. So all the recruiting startups were immediately impacted. Hiring less, but what's interesting here is that it's almost the opposite here, where you see 2/3 are hiring much less. And what that means is that companies' balance sheets were much stronger through this, that actually their revenue was not as massively impacted, but because they slowed down hiring, they slowed down their costs and ended up being in a slightly stronger position. It's also interesting here that around 10% were hiring more. So immediately what they experienced was an impact where their market was growing massively in ways that they hadn't anticipated, and then they were having to increase the hiring. And I think a lot of the hiring, I think people are still hiring less, but it's coming back slowly is what I'm seeing. And then
go ahead. No, I was about to say, which is, I think, a good lessons, to save cash as much as possible. That was definitely the macro message that came out of all the major investors, right? So live like there is no tomorrow for the next 24 months and spend zero. Just expect there's going to be zero cash in.
Exactly. And hire where you need to. If you're a company if you're having to refocus and decide what's important to you, there might be some roles that you haven't filled in. And then I think what that slide also looked at is the companies that were experiencing strong revenue. And I think food and beverage was very strong, which was interesting to me. Fitness, which is what you'd expect, and healthcare. And I think in all of these sectors, this is companies saying they're getting more revenue. And in all of those sectors, we've seen funding go to where revenue is coming in. What's also interesting about this slide that I see is that, obviously ad tech is impacted because companies can cut immediately on advertising. However, we've seen some of the biggest ad tech companies, Facebook and Google have still done pretty well through the crisis. What we're beginning to see is recruiting and jobs, which was immediately impacted, is beginning to come back now. So I'm seeing people hire more. And then also on the travel and tourism side, we are seeing, Airbnb is filed to go public. And so there are pockets of these industries at this point, this was in June, which are beginning to see some strengths in the market going forward as people's behavior is shifting.
Yeah, and we're going to talk about, what's coming up, right? So this new season of IPOs, which I think is going to be very interesting. Before we go there, again, bread and butter of Crunchbase, let's talk about the global VC funding. So just share numbers of the last few months, in particular compared to last year, if there has been any visible change. So again, I think we have a contribution. If you can go through those Instagrams are, I think, by month. Again, so maybe you can help us understand what's been changing.
Yeah, so we at Crunchbase have been tracking, and at Crunchbase News have been tracking very closely funding through the pandemic, and we've been doing these sort of monthly recaps of what's happened in the last month, just to keep up with the shifts and the changes. And I think what's interesting here is that you'll see in January and February there was a pullback if you compare to earlier on in the year, so there was definitely a bit of a pullback. But then March, April, funding has kind of taken off. And I think the market sentiment, March seems a little bit early, but there was this sense that, hang on a minute, we're seeing companies that are showing stronger revenues through this crisis or growing through this crisis. And so what we've seen is that venture has actually been incredibly strong. And I did an analysis of, January through August this year was 183 billion invested, which includes seed, venture, and private equity to venture-based startups, just because we want to reflect that whole sort of ecosystem to startups. And if you compare that to January through August last year, this is global funding, it was also 183 billion. So I think funding, despite the reset, and despite the fact that people are very concerned that there are startups that have, there have been big layoffs here in the Valley. Despite the fact that all of that's been happening, nonetheless, it's been very strong. I think the other interesting thing to note is in August, we thought August was stronger this year by $1 billion than last year. We thought it would be even stronger just because everyone's sitting at home and they're at their desk. No one's taking holidays. But there is a seasonality to this, and so it's come down. So it'll be interesting to see what September is looking like.
So overall, I think that, if you see the trends, it doesn't look like it has been a huge impact. If anything, the trend is very much mirroring what happened last year, which was a pretty aggressive year of funding. So definitely no big changes there, which is, again, good news. Speaking of, at one level up of the funding machine, that is the, how funds are getting created and new funds are going through another cycle. I think that there was a very interesting articles that you published probably 3 or 4 weeks ago about the mega venture funds, and how is that today the case that larger size funds actually got created even in a quicker cycle than before, in particular, if you compare to previous years. So can you talk about that?
Sure. So what I did is I wanted to look through the crisis at the mega funds, so those who've raised the most money and what their investing patterns have been this year. And what was interesting to me is that, so this year, you would think in this crisis that funds couldn't raise funding, but I think we have around 26.6 billion globally raised by mega venture funds just this year so far. So it's been a very, very strong funding year. I think NEA raised 3.6 billion. Lightspeed has raised a huge amount. So there's been a huge amount of fundraising by these mega venture funds. And so what I looked at was they're investing for new versus follow-on, because when there's a crisis, everyone has to look at their portfolio and check in with their portfolio and make sure that their portfolio is strong and healthy. And what I found was a little bit different in that investment firms were investing in their portfolio, often not leading, so doing follow-on, which suggests they were strong because other people were coming in to lead those rounds. But they were also investing at quite a strong clip in new companies as well. And I think the reason for this goes back to the 2008 crisis, also because of what's happening today, which is with everything becoming digital and everyone going online, a lot of companies are seeing growth. And so there's an opportunity to raise. And what I heard from some of the leading investors that I've spoken to is that they invested in companies they've been following who weren't necessarily wanting to raise, but decided they might raise now just because the market's a little bit unsettled. And so given that they've got these growth spurts, given that it's a good opportunity for their company, they might as well raise now. And for those investors to get into some of those leading companies, they want to do that as well. So I think from the mega fund side, they've been very active in their portfolio has been active, but also new fundings as well.
Is there a sense that it was easier for them to raise their current funds at that sizes? There are actually funds that have raised three. Management company that raised 3 funds at the same time. Is there a sense that there is enough capital out there to be deployed at the LP level? Yeah,
I think there is. I think what we're hearing in the market is if you're a new fund and you don't have a track record, it's very, very difficult to raise. But if you're an existing fund with a huge track record, it's not that difficult to raise. And what you find is the existing LPs, if they don't get into this fund, they'll lose out on the next fund. They almost lose their place with these leading firms. And so there's always going to be an appetite from the LP side to get into these leading firms again, because if they step away for one fund, the likelihood of them getting in at the next fund is not going to be there. And so I think the funds haven't had any issues with fundraising from what I can see.
Obviously, the fact that institutional investors and the stock market has been, actually to some extent going in the opposite way than the real economy has helped. So there's still, the financial environment is still to some extent less impacted, and with some areas of euphoria, in particular in tech, in few areas of tech, obviously some that have a direct impact with digitization of everything in our life, but some that are just riding a trend that to some is too euphoric from and detached from the reality. But we might talk about that at the end.
I think one thing just to say on the slide you showed is what you'll see is at every stage for these 18 investors, the median and average went up between 2019 and 2020. So that was a slide just looking at those firms?
Yeah, was about to say, I think there are two points there I wanted to address. First is as you mentioned initially, that there is a larger than usual amount of late stage in investments. So I think is 66% versus the 59% from last year, which is understandable exactly for the reasons that you mentioned before. But then very interesting is those numbers. So why don't you comment the average and median funding from last year?
Sure. So what I'm looking at here is at each stage, seed, Series A, B through C, looking at 2019 for this period, which is January through July in 2020, just for these 18 funds. And what's interesting, at every single stage, the median and average has gone up. And median can be a better indicator just because it's the midpoint. What I found, the stages which grew the most in this was seed and Series C. So that's incredibly interesting. And I think it's because the late stage, as we've seen with the public markets, is incredibly hot. There's a lot of companies who want to come in at the later stages. And so Series C saw the biggest bump. I think what this also indicates, this slide, is that these companies were strong. They were performing well. They were seeing growth. And therefore, these round sizes are up, which suggests that the valuations are up as well.
Yeah, that was one of the questions that I had, which is counterintuitive. So I think the word on the street was that overall, even if funding is still available, the average evaluation of startups would probably go down. So there's been a little bit of a, balancing out of a over-evaluated companies that, especially in the Valley, we could have seen in the last few years. But that's clearly, from this data, that doesn't seem to be the case.
So yes, from these funds, that doesn't seem to be the case. And more broadly, when we look at our data set, we're not seeing rounds come down. So I do believe some rounds are coming down. I do believe there are some pockets. But if you think of it from an investor's point of view, you're looking to invest in the strongest companies who are performing the best, who have a technology which is going to break through. And so you're not looking for a deal. You're looking to invest in the best, and those best deals can be very competitive. So we have seen, just for these companies, rounds have gone up, but more broadly in our data set, when I look at it, I'm not seeing rounds come down in this period, which is different from what you expect and different from what people are saying. We're not seeing it in the data. Again,
reality check from expectations.
Yeah.
One other area that we cover quite a bit, because we are closer to the world of innovation from corporates, is the corporate venture capital, so CVC. Again, if you were to use historical data in crises like this, whether it's financial or real or economic, in this case is across the board, the first budget that can get impacted are budgets that are discretionary to some extent, and so a lot of corporates, not exactly rightly so, cut expenses on areas of innovation, whether that's through their investment in funds or their areas of a CVC. Do you have any data about that? And we can talk about some of what we learned, but it's interesting to know what Crunchbase.
So I'll tell you what I've learned. Yeah, I'll tell you what I've learned, and we can see if this marries it. So what I've seen in our data is that since 2012, corporate venture has become more active in the startup ecosystem, and it has grown almost every year. And I think 2018, 2019, and this year as well have been incredibly strong from a corporate venture side. So when I looked at the data, there was about 130 firms investing in 2012. In 2020, it's about 360 around the globe. So I think there are many more corporate venture outfits out there investing. And then if you just look at some of the deals this year, so we had Facebook, Google, Qualcomm Ventures, and Intel Capital all invest in Reliance Jio. They raised something like 20 billion this year, which is part of those numbers and is part of why late stage is so up. We had Mitsubishi invest in Gojek. We had Walmart invest in Flipkart. So I think the corporate appetite or interest in disruptive companies or companies who have a huge consumer base that they want to ally with, I think hasn't gone away. And so we've seen, anyway, from our numbers, 2020 has been very strong. I looked at the leads in, corporate venture firms leading rounds, and it married 2018, 2019, and 2020 were all over around 10 billion.
Yeah, so yes, our data marries. I think we're going to present right after our conversation. The latest data that we have, it is about corporate innovation in Silicon Valley. That includes a subset of data that we gather from the influence of CVCs in the current rounds in the last 3 or 4 years. And actually we were experiencing the same data. Another data would be interesting to see, maybe today is a little bit early, is the potential impact of the international capital flow. That another data point that we gather through the report that we're launching today is really the origination of capital when it comes to LPs that then gets deployed in Silicon Valley. We know there's been a steady increase of international capital, in particular from Asia, in particular from Japan, but not only. So that's a very interesting, data to compare whether or not this global pandemic will have an impact of how the deployment of this international capital will play out. Probably too early to see.
I'm very interested in that, and that's something we don't see in our data because we don't capture LPs, but I'd be fascinated to know what's happening. So I look forward to hearing about that from you.
Again, I think overall positive points, at least better than expectations. The big one that I think that is coming out is the unicorn factory, right? So the fact that I think even Isidro was talking about the European Council, Innovation Council, how they are now, dedicating billions of euros in this case, really to support the unicorn factor that has become one shortcut, of production of potential success stories. So let's talk about what's coming up in the pipeline. You mentioned the potential IPOs, but maybe some new unicorns and the ones that we think that are ready to go IPO.
Yeah. So what's interesting is on the unicorn side, there's over 600 companies on our board. They're worth $2 trillion collectively, which is what Apple has been worth more recently.
Wow.
And they've raised just around $500 billion. So it's been a very hot month for unicorns going public. We had 10 file in August, and I think more than half of those have gone out. So I think Palantir is still to go out, and Asana. But we've already had Snowflake, Unity, GoodRx has gone, JFrog has gone, I think Sumo Logic. So anyway, it's been very, very hot on the unicorn IPO side. And for those 10 unicorns, the most highly valued is Ant Group. That's worth $150 billion. And I think collectively, they take about 10% of the $2 trillion value off of the unicorn leaderboard. But most of that is assigned to the Ant Group out of all the companies going public. I think what's interesting and what I looked at is I looked at unicorns that were IPOing. What we find in the unicorn base is 2/3 of them when they exit IPO, about 1/3 get acquired. And it's definitely the companies that IPO that perform or provide a better return, especially because over time, as these companies grow, those investors get to benefit. So I think for a lot of investors, if you look at their very high performing companies, they would prefer for those companies to go public. And I did some analysis each year looking at the IPO market based on the last private valuation and the price at IPO. And 2020 has been the highest performing. There's been an 83% increase from the last private valuation that we have for that company and the price at IPO. And that is obviously that many of those companies are performing well and going up even beyond that. So that initial 83% pop from the last valuation, they're performing even better. Yeah. And if you were in early, you obviously got in. The multiples are much lower. So, I think 2020 has been a huge year for the tech market with IPOs, companies going out and then performing, by and large, performing very well.
I mean, 83% increase after the last evaluation is huge. And again, just a reminder, that is the main engine of the venture capital market and investors at large, is the fact that those gains of a few hits that they might have in their portfolio, that's eventually what creates, again, wealth that can be redistributed back into the market. So it's a huge positive data point. All right, last few minutes, looking ahead. Again, we've been using data for the last months very deeply, but let's try to project whatever we can see in the market. I think one of the main macro trends, and it is goes even outside of our world of reference of innovation, but it's just at the core of today of the financial market, is how tech has become literally in the last year. Obviously, it's been accelerated through the pandemic, but really the cornerstone of the financial market in general, and any movement of the core of tech is really, creating waves all around. Do you think that this is here to stay, or it's been, exacerbated by the pandemic that involves a digitization of all our economies?
Yeah, I think it's here to stay, because I think these trends or the shift towards digitization, an interesting company is Shopify. They went public in 2015, and they've seen massive growth during this period as they bring shops, into an online environment. And so I think, and if you look at the top 10 companies, the top most valuable 10 companies, I think 7 of those are tech, and 4 of them were created in the 97 to 98 time period. So it's the Amazons and Googles of the world. And then one, Facebook, was 2000. And so if you look at this stream of, and if you think of what technology breaks we've gone through, which is basically the biggest have been cloud and mobile, and those were 2006, 2007, we're 10, 11, 12, 15 years into that. I think what's interesting is the technology and the companies coming out of those headwinds are going to be leaders in the next wave. And, so I think tech leading, I see that continuing, that's going to continue.
You started talking about this, but would you think, based on today's trend, they're going to be the big winners of 2020 or 2021? I mean, whether it's industries or sub-industries or specific players that you think are set, in a acceleration pattern?
Yeah. So I think what I see is there's going to be many winners. Because if you think of what we're going through, I was looking at a recent report from Stanford, and they said 42% of the US workforce is now working from home. And when you looked, and I think there's 160 or 70, there's a huge number of people who are in the US workforce, 160 or 70 million. There was a report in January saying it was 4 or 5 million people working from home. So if you think of that shift and what tech has to enable for that shift, if you think of the fact that I think across the globe, 1.2 billion children are doing homeschooling, these are incredible numbers for fintech. And so what I see is winners across many, many different categories. And I think, I looked at the biggest IPO in 2019 was Zoom, and in Snowflake was this year. And I think what's interesting about both companies and what they have in common is that they were both built in 2011, 2012 is when they were founded, and they were built for cloud environments. So they completely optimized for a cloud experience. And what we found is something intuitive, seamless. It's very much easier to use. It's fast. And so I think the companies that are built based on today's technologies, and given there are many, many more infrastructure players to help you get there, I think we have huge numbers of consumers, for many different services to appeal. And, if you look at, as I said, online learning, fitness has completely shifted online. I have a friend who's a psychiatrist, and she is now mainly doing teleconferencing. She does some in person, but her whole practice was in person before. And she says there's no ways they're going back to in person. They'll be doing a lot of telehealth because it's more convenient. It's easier for people. They can check in more often. So I think all of these shifts that you're seeing to digitization, which are huge, that just enables a whole lot of tech infrastructure and consumer services. And I spoke to an investor, Sapphire Ventures, a while back, and they were saying to win in this market, you can't just focus on the B2B or the enterprise side. There are huge consumer plays and wins as well. And I think one of the spaces where we've seen that in EdTech, where many of the leading EdTech companies have something for an individual all the way through to a solution for schools and other populations. So I see lots of winners across many different spaces.
Well, thank you so much, Gené. I think also a lot of positive trends, a lot of positive data in this madness around us. So we thank you for that. We thank you for your insights, and hopefully we're going to see you soon. Thank you.
Perfect. Thank you.
Bye. Take care.